Hello traders everywhere, Adam Hewison here, president and founder of iknow.com and co-founder of MarketClub with your midday update for Tuesday the 8th of January. After the bell, today Alcoa kicks off the earnings season. So we're going to be covering Alcoa in our video today, and I'm going to show you exactly what we think of this market. So let's go right to our portfolio, and we'll start off as we normally do with the major indexes, the S&P, Dow, and NASDAQ, all 55, indicating a trading range. Now, we were not so excited when we came back from vacation and saw that the market was up towards the high level of its previous highs in September and October of this past year. So in fact, if we just put that in, you can see quite easily that this is what we consider the line of death right here. This is the market where it has real problems getting over this level. Not to say it won't happen in the future, but for now, we don't think it's going to happen. A couple of things stand out in our mind, and here they are. One is you have a little bit of a divergence right here on the Williams percent R. Notice the prices are going higher, and it was losing momentum. Not a good sign. Plus, you're down today, and you've got a minus 55, indicating really you're in a trading range. Okay, so if you're in a trading range and you're at the top of the range, which we are, I think, right here, you're going to see the market come back to the midpoint, usually, of the Donchian trade channel. So I'd be watching for that market to come back down. It's probably about a 50% Fibonacci retracement, but it should find support right around, I think, the 1430 level. So another 20 points, 25 points from where we are right now. So let me clear the screen, I should say, and go to our next market. And that's going to be the Dow. And the Dow is pretty much the same picture, but it didn't get quite as much momentum as the S&P 500. So you can see we expect that to come down. Again, you've got little divergences on the Williams percent R. Again, you have a 55 trading range scenario. So I think we can get down to the 13,200, 13,100 levels in this market. So on the NASDAQ, not quite as strong as the S&P 500 again, but a mixed bag there. Intermediate term trend up, longer term trend down. You're at the top of the Donchian trade channels. I think we'll see this market pull back to maybe the 3,025 level. But first of all, it's just going to get choppy. We're still in the silly season, which is hard to believe. The silly season does not end until next week. So you've got thin volume, low volume. Markets can be pushed around with relatively few shares, and that's what's happening right now. But let's take a look at one of the markets we talked about before, and that is crude oil. Now, this is crude oil, it's the February contract, and what we're seeing in this market is the following, is this looks like a really, really nice base. We call these energy fields. And what energy fields do, there's no pun intended because this happens to be crude oil, but energy fields tend to drive markets on the upside and the downside depending on where they're developed. Now, this is on the downside as far as we can see because we got down to 86, and it looks as though we're trading at 92, almost 93, but the big number to watch here is 94.87. If you see the market go over that level, we're off to the races. But we also shared with you yesterday some information that I think you may still remember, but we'll take a look at it again. So let me clear the screen, and we'll go to a very, very simple chart. And that's going to be a line chart. So just click here, line graph, boom. I'm going to take away the Donchian trade channels, which are developed by Richard Donchian in the 40s, and also the parabolic. So we have a very, very simple, and I'll take the triangles off as well. So you can't get a simpler graph than this. And this is what I want to share with you. This is one of the most powerful tools in technical analysis and trading, and something that most people don't even talk about anymore. Here it is. It's a simple trend line. So we'll draw a trend line from the very high point all the way down here, and that's a downtrend line. And this is an uptrend line. So what makes a trend line? Well, what makes a trend line is this. You need to have a trend line to be valid. It needs to really touch 3 points, at a minimum of 3 points, 4 better, so forth. So there's 3 points on the top side and the bottom side. Now what happens here, this is what we call a coil formation. The market's tightening up, tightening up, tightening up. Eventually it's going to break out either on the upside or the downside. My guess is, given the fact that we're in this sort of pre-inflationary scenario, then we're going to see this market come down and then boom, it's going to break out on the upside. But the key to remember, as I said, is 94.87. A break and close over this level, this trend line, if we close up here, then I would say that's the start of the move. But our trend line is very, very important. The simplest way to look at the markets and one of the most powerful ways still to analyze a market. So let's clear the screen off and let's go to our next market. And the next market we're going to be looking at is the euro dollar. Now this euro dollar is becoming very, very flat. It's just flat, meaning really since September, mid-September to now, it's really been stuck in a range between, let's say, the 132 level on the upside to about the 127 level, 128 level on the downside. It's really been locked in that range. Right now, technically, it looks as though our triangles are still positive, longer term and intermediate term, still positive on the euro dollar, not the US dollar, but the euro dollar. So the trend appears to be up. We've had a pullback. I would imagine we'll see this market regroup and move higher. And if we put a very simple trend line in, you can see, bingo, we're getting very close to support at 130. So let's see how that plays out. Next market we're looking at is gold. Gold has really been in a pullback phase from the highs that we saw earlier in October, September, October. But if we put in our Fibonacci tool, and that's what we're going to do right now, we'll go from the very high point right here, drag this down to the low point. You can see we're back down to an area of 61.8%, 50%. This is where the market should begin to find support. And I don't want to suggest buying gold right now because I like to see a momentum switch, something to turn this market around. We haven't seen that yet. But pay close attention to this because this is getting close to an area of good support and we expect to see the market go sideways for a little while longer. So let's go to our next market. And that's going to be silver. Much the same picture in silver. It's sort of pullback, still in a negative mode, going sideways for the last month or so, certainly the last 3 weeks. We need to see more base building before we can get excited about being long silver again. But right now, you either should be on the sidelines or you should actually be short this market. So moving along to copper, I'm going to put a candlestick chart on. You can do that very easily by just clicking right here. And there's the candlestick chart, and we'll get a little closer action here. So 3 months, and we'll also put our Donchian channels on because we love those, and also our parabolics. So here we are back in a situation where we've moved out of the top of the channel, and quite often this happens when you can move out of a channel and then you move back into a channel. So what I mean by that is this. So if you move out of the channel, which is right here, and you can pull back to the midpoint. And I think that's what's going to happen in the Dow, NASDAQ, and the S&P 500. We're going to pull back to the midpoint of the channel, and we'll see what happens then. But generally speaking, the trend in copper, the longer-term trend is bullish. And the intermediate-term trend is ditto, and that's bullish. So it looks like this market wants to go higher once it's finished this regrouping. So let's see how that plays out. So let's clear the screen and go to our next market. And the next market we're going to be looking at is going to be Alcoa. And I promise you we look at this because Alcoa announces after the close their earnings. Now the two things that stand out to me here, I'm going to get real close on this one, is the first thing that jumps out at me is yesterday's market action, which I do not consider to be positive. And this action right here, see this large red candle, that is I call this a negative engulfing line. Now some people call this a bearish engulfing line. I like to choose negative because I think it's negative on the market. Now what it means is the market opened higher than the previous day's close and closed lower than the previous day's opening. So it gives you this negative look. Completely engulfs the previous candle. Now the key today is if this market closes lower on the day, and it's about unchanged on the day right now, if it closes lower, it confirms this negative engulfing line, indicating we're probably going to come back down to the midpoint of the Donchian trade channel. I would say right around the 885 level. So we'll have to see after the close. But on top of that, you have our monthly trade triangle is negative. Okay, and this is what I want to share with you. This is our exact position. Our intermediate term trend here is positive. So what does that mean? What it means is basically you are neutral and out of Alcoa. So you don't care what is going to happen this afternoon after the bell with these earnings, because you're out of the market, because you have conflicting trade triangle signals. Very, very important to be disciplined and listen to these signals and to what's going on. So you have not only the trade triangles saying negative, but you also have the bearish engulfing line. So the chances of this market being a surprise to the upside, I think, are very, very, very small. Somebody knows what's going to happen, and the action is shared with you with the price action in the stock itself. So let's clear the screen and go to our next market. And this is the stock we picked up today. You can see the monthly trade triangle came at 26.75. It's currently trading at 28.66, so it's almost $2 profit. Came in, everything's a go, plus 100. We like stocks that have that kind of momentum and that kind of profit on the upside. So if we scope this out further, so we go to, let's say, max, we can see that we could potentially go up to the 35, 36 level, which takes it all the way back to the 2007 area that we saw prices at. So let's see how that plays out. But today was the buy signal at 26.75, plus 100, everything looks good. So let's go to our next market. And this Pfizer, again, I'm going to get close into Pfizer because this is a situation where, let me make this simple chart. And I'll take off this and this. So a very, very simple chart. And we'll just do a line chart. Boom. And you can see we have a signal at 26.09. It's currently trading at 26.15. In the money, profitable, plus 100s on the upside. So it looks like it wants to go higher. And indeed, it should go higher. If we close over 26.20, 26.15, I think we're in good shapes to challenge the 28 level, which would be pretty much with the all-time highs in Pfizer. So let's go to an interesting trade we figured out and I want to share with you. And I want to go back to my portfolio manager, and I'm going to go to the service area. Now this is more like a trade, a professional hedging trade. And what it is, I want to close this up here. It's Walmart, which is minus 100, and Amazon, which is plus 100. Excuse me, what this is telling you, what this is telling you is that you want to be buying Amazon, which we talked about yesterday. If you remember, we said to buy Amazon, and selling Walmart. So here you are, you're seeing a little bit of favor in terms of the price action in favor of buying Amazon and selling Walmart. You got a little higher prices on Walmart and a little lower prices on Amazon. And how you would do this is very simple. You would simply take, let's say whatever the number is you have. Let's say it's $50,000, for example. Okay, that's how much you want to spend on these two stocks. Then you divide that by 2, and that gives you 25,000 and 25,000. So you have two buckets of $25,000. Okay, so you'd simply buy $25,000 worth of. Excuse me, you sell $25,000. So you'd sell Walmart, and it's MT, and you'd buy Amazon, AMZN. Okay, so once you do that, so you buy $25,000 of Amazon stock and you sell $25,000 of Walmart stock. And what you're looking for is the percentage change between the two of them to widen in Amazon's favor. You don't care which way the markets go. You just want Amazon to go up and Walmart to stay the same, or Amazon if it goes down, Walmart percentage-wise to go down further. So that's the trade. The last time we had a trade like this was basically buying apples, selling rims. So this is maybe not quite as sexy, but certainly in the same league in terms of spread. But hey, we've covered a lot of ground today. I hope you enjoyed today's show. We'll be back tomorrow with our big show with Jeremy, and let's see how these markets shape up, and we'll go from there. I'm Adam Hewison for Walmart and Amazon and MarketClub. Have a great trading day.